Good day, learners. It is a great opportunity to get across to you through this particular medium. We are going to look at a topic tagged the principal book, that is ledger. And this is under financial accounting. Before we go ahead and look at this particular topic, get the necessary things or materials that will support you in the course of this particular class. Now, before we go ahead and look at this in detail, we are going to look at the learning objective. The learning objectives include one, that at the end of this lesson, you as a learner should be able to define a ledger. 2, list and explain the classifications of ledger. 3, draw the format of a ledger. And number 4, define an account and its different classifications. And then number 5, apply the double entry principle in posting transactions into a ledger. What is the meaning of a ledger? A ledger is the final destination or location of all transactions in the subsidiary books. And when we say subsidiary books here, we are referring to the sales day journal, purchases day journal, return invoice journal, and returns outward journal. So all this, with the posting from all of them at the end of the day, are taken to the ledger. It is the most important book of account. What are the various classifications of a ledger? The different classifications of a ledger include the following. 1, personal ledgers. And when we say personal ledgers, these are the ledgers for creditors. These are the ledgers for creditors account and debtors account. For example, purchases ledger and the sales ledgers. So they are categorized under personal ledgers, as they consist of the names of either the buyers of the organization, that is the customers, or those who that have sold some things to the organization. Then apart from that, we equally have general ledgers. These are the ledgers for real and nominal accounts, e.g., expenses account, incomes account. So these are referred to as, these are categorized or recorded under general ledgers. Then apart from general ledger, we equally have those ledgers that we refer to as private ledgers. They are private ledgers in the sense that they are ledgers that record some things like capital and drawings of the proprietor. That is, they are private ledgers and they record some transactions like the capital account, like the capital of the proprietor rather, and the drawings made by the proprietor. It is made up of different sections known as accounts. Then we have purchases or creditors ledger. So this ledger contains personal accounts of suppliers, that is those who that supply some items, or those who that are our creditors. And apart from that, we equally have sales or debtors ledger. So this ledger contains personal accounts of customers, or those who that are our debtors, those who that are supposed to pay us maybe some amount of money. Then we equally have nominal ledger. So this ledger contains accounts of some transactions like losses, expenses, incomes, and gains. So they are ledgers that record these transactions that are more or less like items that one cannot actually see physically, but they occur or they take place in the organization. The format of a ledger. A typical ledger appears as shown here. We have the debit side, and then we have the credit side. And the debit side starts from here to this point, while the credit side starts from here to this point. And at the two sides we have date, particulars, folio, and amount at the two sides, thus making us to have 8 columns at the two sides of a typical ledger. Description of the format of a ledger. A ledger, like I mentioned, is divided into two parts, and they are the left side, that is the debit side, and the right side, which is the credit side. There is columns for date, description, folio, amount at the two sides, like I mentioned. So we have four columns at the two sides, and thus making 8 columns in a typical ledger. What is the meaning of an account? We make use of this word from time to time. We are having an account maybe for a motor vehicle, an account for cash, an account for bank, and so on and so forth. An account is a record in a double entry system that is kept for assets, liabilities, incomes, and expenses of an organization. An account is a record in a double entry system. In other words, it is recorded or kept following the double entry principle. And it could be for assets, liabilities, incomes, and expenses. It implies that recording of transaction is based on the double entry principle, like I mentioned. What are the different types of accounts that we have? The various types of accounts include personal accounts. These are accounts for the names of individuals, firms, and business organizations. That is, it has as its title or as its name the names of individuals, firms, and business organizations. Examples include Bade account, Greenland, Nigeria Limited account, debtors and creditors accounts. Types of accounts continue. We also have impersonal accounts. These are accounts for the properties, items of expenditure, and incomes. Examples include Bade account, Greenland Nigeria Limited account, debtors and creditors account. And it is subdivided into real accounts and nominal accounts. What are the rules for recording transactions into the various accounts? The rule for recording transactions to the various accounts include 1. Debit the account that receives or gain value. And 2, credit the account that gives or loses value. Illustration. January 1, Mr. Ojo started business with 10,000 naira cash. So, and what happens thereafter? To show this transaction in an account or in recording to the account, the 2 accounts that will be affected or that will be involved are the capital account and the cash account. Capital account and the cash account. So you are expected to debit the cash account with 10,000 naira because the 10,000 naira is going into the cash account, and then you debit the capital account as the capital account gave out that particular amount of 10,000 naira. And in recording them, so it's going to appear like this: debit cash account with 10,000 naira. So this is the cash account now. So, and it's debited with 10,000 naira from the capital account here. Then credit capital account with 10,000 naira. So this is the capital account, and this is the cash that was given to the cash account, and so which is credited here. On January 2, the proprietor put additional 5,000 to the business by check. So the effect will be on the capital account and the bank account. In recording this into the bank capital account and bank account, so we are going to debit the bank account as the bank account is the one receiving the 5,000 naira, while we credit the capital account, which gave out or which released the 5,000 naira that was lodged in the bank account. So in recording them into the accounts, so we are going to credit the capital account with 5,000 naira. So here is the capital account having been credited with 5,000 naira from which was given to the bank account, and then the bank account will be debited with 5,000 naira. So the bank account here so has been debited with that 5,000 naira which was released or was given to it by the capital account. On January 3, bought motor vehicle for 60 naira, paying by check. The effect will be on these two accounts, that is motor van account and then bank account, as it was paid, the amount was paid with a check. So in recording it, so we are going to credit the bank account because the bank account actually released a check of 60 naira, and we are going to debit the motor van account which received the check value of 60 naira, and it's going to appear like this. So credit the bank account with 60 naira. So, and this is the bank account. So this is January 3 motor van received the amount of 60 naira in check. So, and it has been credited there. Why we debit the motor van account with 60 naira. So this is the motor van. This is the motor van account. So, and here from bank. So this account received a check of 60 naira. So it has been debited there. January 4, took part of the cash T, 50 naira, and put it into the bank. So the effect will be on bank account and then cash account. So in the recordings, so we are going to debit bank account with 50 naira, and then we are going to credit cash account with 50 naira. as the cash account gave out that 15 naira and it was kept in the bank account. So the recordings will appear like this. Debit bank account with 15 naira. So this is the bank account now. And this one, the amount, which is 15 naira, from cash account has been debited here. Then, we are going to credit the cash account with 15 naira. So the cash account gave out that amount of money and it was kept or lodged in the bank. So January 4, so the bank received 15 naira from the cash account. So, and it has been credited to the cash account now. Then bought goods worth of 115 naira by check. So the first will be on purchases account and then bank account. So the recordings will appear as shown here. Debit purchases account with 150 naira and then credit bank account with 150 naira. The ledger entries will appear in this format. Credit bank account with 150 naira. That is the bank account. This bank account actually gave out 150 naira to purchase some items, and therefore it has been credited here. So purchases actually got this 150 naira. So it has been credited to the bank account. While the purchases account got this 150 naira from the bank to buy some goods. And therefore, so it has been debited into the purchases account here. Generally, looking at the postings into the various accounts above, one can say categorically that the double entry principle plays an important role in posting transactions into ledgers and accounts. Assignment. The assignment are in two. One, we have 1A, what is a ledger? 1B, state 4 of its characteristics. 1C, differentiate between a ledger and an account. Then D, state the principle of double entry in a sentence. 2, post the following transactions using the T form to indicate the account to be debited and the one to be credited. 1. Started business with money in cash. 2. Paid part of the cash into bank. 3. Bought goods on credit from Mayo. And 4. Sold goods on credit to Ulutu. Reference materials. Simplified and Amplified Accounting for SS by Femi Longe et al. Then Longe Publishers, Lagos. 2. Business Accounting for West Africa by Omuya J.O. Learn Africa Publishers, Ibadan. Thank you for your time and your attention.